In this video, we're going to be doing a brief stock analysis on Exxon Mobil stock, ticker symbol XOM. So we're just going to be looking at some basic things like the recent earnings reports from Q4. Just look how they did in the most recent quarter, look how they did in the most recent year. 2020 was definitely a pretty rough year for the energy sector as a whole. So we're just going to look at some of those results from 2020 and Q4 specifically, and then we're just going to look at some of the dividend information as this is in my dividend portfolio. And as we'll get to, the dividend is kind of not really super solid at the moment. So we're going to look at that, and then we're going to try to look at some potential valuation metrics as well briefly. Hey, what's up guys? Welcome back to the channel. My name is Frank Mularcik, and if you are new here, most of my videos are about stock market investing in dividend stocks, which is what I do for the most part, but I also do some other investments with options trading and some more higher growth stocks and stuff like that. So I like to talk about what I'm doing within my investments, but also do some stock analysis and stuff like that. So if you think you'd be interested in that content, make sure you subscribe to the channel and like this video, as those are both great ways you can help out the channel, and they're both completely free. So we're first just going to look at some of the results from Q4 and the full year of 2020. So they said that they had a loss of $20.1 billion in the fourth quarter, which is pretty substantial, which included unfavorable identified items of $20.2 billion. And companies always throw in these terms here like unfavorable identified items. So I tried to figure out sort of what that meant, and basically it just basically means that these are expenses and things they had to spend money on that they lost money on, that basically they think these are sort of one-time deals and just kind of out of the ordinary. So basically they're saying in the future they probably won't have these kind of problems or these kind of expenses. So accounting for that, they pretty much broke even this quarter, which isn't really too bad, but at the same time they still lost money. They still had those still happened, even if they weren't regular expenses, they still had to pay them. So definitely not great to see that $20 billion loss, but they did say they exceeded their cost reduction objectives that they established a few years ago. Basically, they had capital spending of $21 billion, which was below the target by $2 billion, and this cash operating expense is more than 15% below 2019, and some of that, $3 billion of that is just a structural reduction, which is pretty good, because that basically means that's going to continue that way in the future, I think. And then they also talked about some emissions objectives that they set in 2016, I think. So they had the methane emissions reduction of 15% that I think they met, and the flaring reduction of 25%. So flaring is basically when they burn certain chemicals or stuff like that at refineries, just to control some things there and make sure everything's safe, but they're trying to reduce that greatly, because that's sort of a big deal these days. So they were able to reduce that, and they basically said that they also announced their 2025 emissions reduction plans or goals, and those are projected to be consistent with the Paris Agreement. And they also talked about some expense reductions in the future. They're hoping to have structural operating expense reductions of $3 billion by 2023, which is going to result in a total structural reduction of $6 billion versus 2019. So that's pretty good. It's pretty significant in the grand scheme of things. They said that cash flow this year is expected to cover the capital expenditures and maintain the dividend and strong balance sheet. So they do say maintain the dividend, so they expect to not cut the dividend, and we'll talk about that in the future, but they do need to raise the dividend if they want to keep their dividend aristocrat status. So that's interesting just to look at that minute little wording, but they also say that these assumptions include the Brent prices of oil stay at $50 per barrel or higher. So that's definitely something that affects their business, is the prices of oil. So I actually looked that up, and the current price of the Brent oil index, or whatever you want to call it, is around $63. So it's above the $50 that they talked about, and you can see this is on the 1-year chart. So down last April it was around $25, and now it's up around $63. And if we look out a little bit further on the chart, you can see that it had been falling all of the beginning of last year, and these prices are significantly lower than they were a few years ago. So I think that with the reopening and as the world, continues to reopen, people start traveling more and just doing more things. I think, these prices are most likely not really going to fall any lower, or significantly lower, that is. And in my eyes, it seems likely that they'll just continue rising at least a little bit or stay steady. So in that regards, I think they'll probably be fine there. And this is just kind of tabularized version of some of that data. So the earnings or loss, that is, was about $20 billion, which is about $4.70 per share. And for the full year, they had just a slightly bigger loss of $22 billion, which is $5.25 per share. So that's one thing that is makes me feel a little bit better, just because even though they had this big loss in Q4, it seems to me like most of the damage would have happened in the first few quarters, maybe the second and third quarter the most. And to see that those quarters really didn't affect the overall 2020 as much is promising to see, and I hope that in the next few quarters they will do a lot better. So they actually went on to talk about a lot of super interesting stuff in this presentation here, so I would recommend you check that out. They say that we've built a flexible capital structure or program that is robust to a range of market scenarios and focused on our highest return opportunities to drive greater cash flow, cover the dividend, and increase the earnings potential of our business in the near and longer term. So I can see that, cover the dividend and drive greater cash flow, obviously. So they did talk a lot about some great things in here, but I really just don't have time to go into depth into all of it right now. And just looking at the 10K annual report, the one thing I always like to look at on here is just the balance sheet. And you can see, unfortunately, their total current assets are around $45 billion, and their total current liabilities are around $56 billion, which gives them a current ratio of around 0.8. So that's obviously not ideal. It's obviously best if that current ratio is above 1. But even you can see in 2019, their current ratio was below 1. And I think generally in the energy sector, it's generally more common, I guess, to have a little bit lower current ratio and not always have a current ratio above 1. So it's definitely a little bit concerning to me, but just looking at some of the historical numbers on that, I'm not too worried about it, and I think they will continue to come back strong in the next few quarters. So now just looking at the dividend, the numbers really aren't that great. Right now the dividend yield is about the only number that's pretty great, around 6.23%, which is an annual payout of $3.48. The payout ratio there is 121%, and their dividend growth rate over the last 5 years is only 3.57%. And Seeking Alpha says they have a dividend growth of 0 years. They are a dividend aristocrat though, and they have been raising their dividend consistently. And they actually have a nice page on their investor relations about their dividends. And basically you can see here, even though the dividend amount was never raised in 2020, the total dividends that they paid in 2020 was still higher at $3.48 than the total dividends that they paid in 2019 as $3.43. So if they do increase the dividend at some point in 2021, even by a penny in the fourth quarter, then they will keep that dividend aristocrat streak alive. I don't really expect them to raise it, all that much, because they still are definitely recovering from the pandemic and trying to, get back on solid legs. So this is just the 1-year chart of Exxon Mobil stock. You can see it's definitely come up a fair bit over the last year. They're up 30% just in the last year, and they really took a hit down in October. They were almost down below $30 a share. So from that low there, they're up, about probably close to 100%. 75% there. So they've really come back since the crash. But just looking at a longer term chart, you can see even before the crash, they were still kind of dwindling down over the previous 4 years before the crash in last March. They were down about 18%. So the stock price chart doesn't look that great, but I think they are poised for a bit of a recovery here following the pandemic. Usually we try to look at the PE ratio for a quick valuation metric, but obviously as we look, they were not profitable in 2020, so they don't even have a PE ratio. But for me personally, I'm not really buying any more here. I think it's definitely not the worst price. I think it's a fairly good price, but basically my average cost is a lot better than the current price, and my position size is big enough, and it's plenty big for what I want as far as my exposure to the oil or energy sector goes. So that's why I'm not adding really any more to my position. If it were to see a drastic drop, I might add some more as my portfolio grows as well. But at this point, I'm really not adding. In these cases, you definitely have to do your own research, and I was thinking about doing a DCF calculation on this just because of they didn't even have a PE ratio. So maybe I'll do that at some point in the future, and I'll let you guys know what happens with that. So just looking at my position in my portfolio, you can see I have about 1.3 shares with a total market value of around $74, and this is about 5.5% of my portfolio. And they pay an annual dividend to me of about 4.62%. And the crazy thing is you can see this yield on cost for me is around 9.74%, which is just really ridiculous, almost 10%. So my average cost is pretty good with them. So that's one of the reasons I said I wasn't going to buy anymore. So Exxon Mobil definitely has some problems. They definitely have their fair share, but I would say I don't think the oil industry is really going anywhere anytime soon, even in the next 10 or 20 years. I think it's going to be a little bit longer before this oil really starts to fade away more. And just, additionally, I didn't really touch on this at all, but they really are doing a fair bit to work on transitioning to more renewable sources and just relying less on oil and natural gas. That's definitely still a major part of their business, but they definitely have plans and are working constantly to create more plans to shift away from that and shift into this future of sort of renewable energies that we're going to come to eventually at some point. So I do think if you did want to invest in the energy sector, I think Exxon Mobil is probably one of the best choices. There's definitely a few other good companies out there, but for me, it's my only investment in the energy sector. So let me know what you guys think of the energy sector and kind of what kind of stocks you have, if any, in the energy sector, and what you think of Exxon Mobil specifically, because I think this is one that we could really have some good discussion on in the comments. So definitely let me know your thoughts below, and I will see you guys in the next one.